Hi, it's Stuart. There's been a lot of talk recently about will the RBA hike interest rates? And that confuses a lot of people because they've already hiked interest rates quite a lot. Together, then, with the cost of living crisis in terms of everything becoming more expensive, it's natural for people to think, well, hang on, do they really need to hike interest rates again? And how high can they go? And I wanted to take a little bit of time to sort of walk you through some of the data that the RBA is looking at in determining whether to hike again and whether it's just a whole bunch of noise from market commentators or whether it's something we really need to be concerned about. So I thought we'd start by looking at March quarter CPI data, so inflation data, which is came out last week and is the reason why people are starting to talk about will the RBA hike again. In this chart, you'll see this table which shows you the groups or components that make up CPI, their weighting, so how important or how much influence they have on the end CPI data, what happened in the March quarter, and then I've added some comments to the right-hand side as well. So let's start with housing as the first one. As you can see, it increased by 0.7% in the March quarter, and the main driver of that is rents. Now, of course, there's little you and I can do about the impact of rents and how much they're rising. Of course, that's very much related to population growth and housing supply, neither of which we can do anything about. And which is one of the criticisms, I guess, of people thinking, well, will they hike interest rates? Do they need to? Because there's nothing, the parts or the factors that are contributing to higher inflation, we don't control. And certainly that's true with housing. But the next line item, which accounts for 17% or has a 17% weighting, is food and non-alcoholic beverages. And as you can see here, beverages up 3.4, fruit and vegetables up 2.5, and other food products up 1.2%. If you just sort of annualize those figures just on that quarter, we're looking at 10-ish percent growth or inflation on an annualized basis in that category. That's just too high, of course. Now, to some extent, food and non-alcoholic beverages, that's discretionary. So, instead of buying non-alcoholic beverages, we could buy water, for example, or not even buy water, just open the tap at home and drink the tap water from there. So I guess this category does reflect to some extent too high discretionary expenditure. If you go down the rest of the categories, there's not a huge change or impact. Discretionary is down, recreation and culture is down mainly because of international travel is down. I guess some of the glut that was there as a result of COVID lockdowns has kind of worked its way through the market. Spare parts a little bit higher. Fuel came down during that quarter. So transport didn't really change that much. Furniture and household and services. Furniture's down, childcare's up. So that category really didn't change very much. You see insurance, insurance is up 3.7%. So again, if you annualize that figure, you're looking at a 14% increase in insurance, which is not uncommon. From my personal and professional experience, that's not uncommon to see premiums rise by that amount. Again, that's non-discretionary expenditure, really. And then education. Some of it, that education impact is a little unfair because tertiary fees are indexed to CPI at the beginning of the calendar year, so that happened in this quarter. And also, a new school year in terms of the 2024 calendar year. So, of course, there were some fee hikes in relation to that. But just looking at that data, you would say, okay, look, most of it is non-discretionary expenditure. And so it's a little bit unfair to expect that to change. And in fact, the RBA does publish that information in terms of discretionary and non-discretionary, and we can see the disparity here. So discretionary goods up 2.9%, non-discretionary up 4.2% over the course of the last 12 months. So clearly there is more pressure in that non-discretionary element, and I think there is a reasonable argument to say, well, should they be hiking interest rates if it's mainly in those non-discretionary categories? But also I think what the RBA is going to need to see or want to see is actually maybe some disinflation in the discretionary category. So that is that demand reduces to such an extent that actually prices start to either stabilize or fall, because we're not going to be able to offset the non-discretionary increases, rents and education costs, medical, pharmaceuticals, childcare, insurance. None of those things can we really influence. And so actually we're going to have to see people's non-discretionary expenditure, or at least demand for those goods, reduce dramatically. And we haven't seen that yet. Because one of the things that I thought about is say, okay, we looked at March quarter CPI, but which included obviously January, February, March. And the economy in January is a lot different to what the economy is today in April, May, right? So then I thought, well, let's have a look at the most recent spending data to see how are people spending. And CBA produces this data. It's called the HSI series, the Home Spending Insight series, and it's based on credit card and transaction data. So it's very sort of up to date, and they can kind of categorize the spending as a result of that. So it's really good data to utilize. But as you can see here, the right hand side shows hospitality. Now I picked hospitality as a category because eating out, I think, is a good sign for people's discretionary spend. When their budget is tight, they're going to reduce the amount of times that they eat out. Well, you can see that there's clear upward trend of spending on hospitality. Now you see those large drops there. They're obviously the lockdowns, but the upward trend is continuing. So that sort of suggests to us that really people's discretionary spend hasn't changed that much. Now, that's not true because in certain categories it has, and I'll get to that in a second. And the left-hand chart shows essential versus discretionary spending. Again, both are trending upwards. So clearly we haven't seen the impact of higher interest rates on that discretionary spend element. Another thing that I think we probably have to see is an increase in mortgage arrears rates. And so this chart is from CBA, which has the largest mortgage book in Australia. And you'll note the yellow line is home loans, and the current arrears rate, 90 plus days arrears rate, is 0.52%. The average, or the long-term average, is 0.65. So we're below the long-term average in terms of arrears rates. Sure, they have ticked up a little bit over the last year or so, but they're nowhere near to be sort of concerning levels. And so I would think that for us to be at a setting where inflation is going to be under control, I would think arrears rates have to be above average rather than below average. One of the concerns around inflation and the potential persistence of inflation is wage inflation, because if we're all getting paid more, then we can all afford to spend more. And it's almost like a self-fulfilling prophecy, really, because what happens is that businesses need to put their prices up. And then those higher prices flow through to higher wages for the people that are working in that business, which obviously allows them to sustain higher prices, and you get that inflation price spiral. The employment market is cooling a little bit. One of the complaints by the RBA is that there's two main shortcomings with just looking at the unemployment rate. The first one is that it doesn't look at changes or factor in changes to participation. The unemployment rate might look like it's going down, but that's only because fewer people are actually bothering to look for work. And then the amount of hours worked. You might see the unemployment rate going down, but that's because we've got a lot of part-time workers. So it's not really a full reflection of how healthy the employment market is. ANZ came up with what they call full-time equivalent population ratio. In this chart here, it's FTE POP. And what it does is even out those things. So it looks at the full-time equivalent in terms of hours worked, and looks in proportion to the population. You can see there that it's starting to trend down, and they expect that trend to continue. When that is below 58, and you just look at the right-hand axis there, if that's below 58, which it's going to be, or they project it's going to be relatively soon, that below 58 means that it doesn't contribute towards inflation. There's some good data there, or good news data for the RBA to look at to say, well, hang on, maybe wages won't necessarily contribute to inflation as much. The key thing here to recognize is that monetary policy, which is using interest rates to cool an economy, is a really blunt tool in order to do that. There's a lot of the population that isn't impacted by interest rates. If we look at this data from the 2021 census data, look at Gen Alpha and Gen Z, they're probably not contributing very much to spending either way, whether interest rates are low or high. So we can kind of ignore them. Interwar, which are 75 and older, again, they're probably not contributing a lot to discretionary spending. So it's really millennials, Gen X, and baby boomers. And it's really millennials, or mostly millennials and Gen Xers, that are most likely to have mortgages, whether it's home mortgages or investment mortgages or both. So they're going to be impacted by interest rates, or they're going to be sensitive to interest rates. But baby boomers not, because they're probably not going to have a home loan. If they do have any debt, investment debt, compared to their overall wealth and their income, it's going to be less of a concern. So they're going to be less sensitive to interest rates. We've got a cohort in the economy that is still continuing to go out and, to hospitality venues, eat out, all those sorts of things that are kind of underpinning that demand. And that's reflected in a chart that CBA put together in their most recent results presentation, where I'm sort of focusing on the spending column, which is the one in the middle, and the discretionary spending, which is the yellow bar there, or the gold bar, whatever you want to call it. For ages less than 34, that's a negative figure. So that is the spending, they're contracting their discretionary spending, people that are 34 years and younger. Not a huge change between 35 and 54, but there's a large increase for people greater than or older than 55. And that's our problem. That's the baby boomers, as I just highlighted on the previous slide, that they're really not curtailing their expenditure. So we probably need the 35s to 54s for those bars to go negative, so for them to contract discretionary spending, because at the moment they're broadly keeping it the same. Over the last year, well, we really need that to sort of contract. So what does all this mean? Well, the RBA is going to need to wait until we get the June quarter CPI results. That data, I think, will really determine whether they're going to increase interest rates. If you have a look at what the market believes, which is what this chart is showing, it believes in August there's probably a better than 50% chance that they will hike interest rates. I think we need to see discretionary spending fall a lot more significantly than it has in the past. The younger people are spending less on discretionary expenses, but I think the rest of, the middle to older population need to do the same. And if that is not reflected in data in the June quarter, then they'll be inclined to hike interest rates. And they'll be inclined to sit on that until they get some more data. So I guess September quarter CPI. I'm cautiously optimistic because the employment market has changed a little bit, and the longer these higher interest rates persist for, the more likely it is that any savings that were accumulated throughout COVID start to evaporate or wind down, and then that starts to impact people's discretionary spending decisions. So will there be a rate hike? There's slightly greater than a 50% chance of a rate hike in August. But acknowledge that it's very data dependent. But hopefully that allows people to better understand what's driving these decisions and the probability around it. Hope that's been useful. If you enjoyed this video, please subscribe to my YouTube channel so that you get alerted when I post new videos. And until next time, bye for now.